Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I have been getting requested to look at Uber for the last few months, but I unfortunately have not had the opportunity to put a video together. But today that's exactly what we're going to do. We're going to look at Uber today. We are looking at the financials, we look at the business model, we look at the projections moving forward. And I'm going to tell you exactly what I would be doing personally. I've always been honest and transparent with you guys. What you see right now in front of you is my portfolio of £116,000. And as you can see, it goes up, it goes down, but I've shared that with you guys every single day. And I'll tell you exactly if I would be adding an Uber, if I will not be adding, why, and so on. And at the same time, it's always important to do your own research and find out more information about these companies that we share here. So I've got quite a few requests from the community asking me to look at individual stocks. So in the next few days, inshallah, I'm gonna put those videos together, and I've actually prepared a few of those already, so I will be sharing with you guys with basically all of that, as well as of course a portfolio update. So today or tomorrow, inshallah, I'm going to do a portfolio update. This is not going to be the normal portfolio update because we haven't done one for a while, and there's a lot I need to go through in, inshallah, and explain. So yeah, inshallah, stay tuned for that. If you are here for the first time, join us in this community, like the video, subscribe to the channel, and of course join us in the Patreon account where you get access to the Discord, you get access to a lot of these things, the trackers that I normally use, the watch lists that I use, and also I actually post all the basically high quality stocks for monthly I can't even talk, the high quality stocks picks for the month, as well as of course the undervalued stocks and so on. So let's get to the stock that we came here for today, and that company is Uber. We already know the Uber's business model. Okay, it's very simple. You've got the ride, you've got the Uber Eats and so on, and we all know how it works. But what we want to know is this company profitable? We want to see if it's actually where it's been over the last whatever years and where it's heading, and if there are any competitions, anything we need to worry about. And then I'll share with you guys at the end of the financials basically the valuation to see if this company is a buy, hold, or whatever. As you can see, Wall Street is actually very bullish on this company. Quant is actually saying it's a strong buy, and Seeking Alpha analysts actually saying no buy. So all around, basically, we've got triple buys here. Now the first thing we're going to look at is this. Okay, so you can see a year to date, the S&P 500 is about up about 25%, but a year to date for Uber is about just 6%, and for the last 6 months is actually flat. And when you think about 1 year, it's 12% up, 12.5%. For the last 5 years, 127%. So if you bought it 5 years ago, right now you'll be up 127%. And if you bought it 10 years ago, of course it didn't exist, so 2019 is basically when it came into existence and so on. Now let's have a look at the financials, because we want to know if this company, and this is basically what you should be doing if you invest in the stock market and you want to basically learn about how to invest individual stocks and do the research. This is where you should be starting. First, understand the business model. It's not that difficult, because if we go on here, you can see the business model. What they will tell you exactly is what we already know. Okay, basically what countries that it operates, and operating through three segments: mobility, delivery, and freight, for example. And then they give you a breakdown of each what they are. Okay, so the ride sharing is the most important part, as well of course the delivery. Okay, once you understand that, the next part is the financials. Okay, this is the most important part, and the first thing we need to look for is revenue, because that's the sales, that's the basically what the company basically how the company makes money, right? So we want to see, are they making good money? First of all, in 2016, 3.8 billion of basically total revenue. That's what they made in 2016. And as you can see, it's growing every single year to the point right now we are for almost to $42 billion. That's absolutely huge. And next, we're going to look at the cost of that revenue. So how much has the company basically invested or used, okay, to make this much basic revenue? This is huge. The fact that they're making from 2016 to 20 right now to make a 41 billion, almost a 42 billion dollars. That's absolutely huge. But this is how much they spend. So from 3 billion to 28 billion dollars, which means that if you take away from these two, you will basically be left with 13.7 billion dollars of right now of gross profit. Now, of course, that's not the final thing, because the company will have some sort of a sales and basically general administration. You've got research and development. You've got depreciation, amortization as well, and the other expenses. So you've got a lot of things that you need to take care of. Okay, you've got the operating income of 2.6 billion dollars, and the bit that we're really interested in, after they've done all the expenses, interests, and all of these things that they paid for, what we're interested in is the net income. So the net income as we speak right now is 4.4 billion dollars, and basically in 2016 it was actually negative. So the company was not making any money over the last whatever years, but right now, as you can see, is actually making 4.4 billion dollars of free cash of net income. We will see the free cash flow in a bit. Okay, and then the basic EPS was basically negative. Okay, in 2016, and right now, as you can see, we're over $2. Okay, which is absolutely fine. This is basically what you expect from a growth company every single year, just to basically start making a little bit more than they did, to the point where the last two basically years the company has been positive. They had a positive year. I thought they had a positive year here, but there you go. So you basically, for the last 2 years, they have been basically positive and EPS when it. Okay, right. So the next thing we need to know is the balance sheet. So the balance sheet, two things I'm really interested in is basically the currently, because you don't want to buy companies basically that's going to go bankrupt very soon. We want to see the total assets for the company. So that's $47 billion. So that's what the company has right now in terms of entire assets. Okay, and we want to compare that against the total liabilities, which is basically this one here. If I can find the total liabilities, where did it go? Total current liability. There we go. Total liabilities of $30 billion. So total assets of $47 billion, total liabilities of 30. So they can easily take care of that, which is really good, which is what we want to see. Okay, and then we can go to the cash flow here and look for cash flow somewhere, basically to see the free cash flow, and that's the bit that we're interested in. Okay, so this is the one that we're after. You can see right now $3.8 billion of free cash flow right now, but that's levered to basically free cash flow, and of course slightly different. Okay, so that is the first part. So now we can see the company is not in a lot of debt. In fact, we can even see the total debt if we can find it here. If we go back to balance sheet and scroll all the way down, you should be able to see the total liabilities total debt for the company, because it is important to know if the company is in a massive debt, if it's and so on. Because as long-term investors, one thing we don't want to do is invest in companies with a massive debt. So as you can see, the total debt is about $13 million right now. Okay. Well, now we've done that, let's have a look at the rest of the information, okay, basically in this format. So as you can see here, basically the company we're talking about is Uber Technologies. Currently has a market, basically current stock of $65 per share. EPS about just $2. We've already seen that. The market cap is $137 billion. So it's becoming a huge company. They don't have a basically moat, and this is for me the most important part. The reason I say that is because there are so many companies out there competing with this company. Maybe not in the US so much, but I've been to basically recently places like, for example, Thailand, I've been to Malaysia, I've been to other European countries where there are local companies or local apps that allow you to do exactly the same thing. We've got the UK, we've got Bolt and so on. So there are so many competitions out there, and I don't think this company will monopolize that market unless they kind of start innovating and so on, because we've got autonomous driving and all of these things. But I don't think they will have a wide mode anytime soon. Current beta is 1.3, and PE right now is about 32. The forward PE is about 38, and the 5-year average is about 72. The sector medium, okay, is basically, because this is industrial for some reason, sector, so it's about 25 right now. The free cash flow is about $6 billion right now. Free cash flow compounded annual growth rate for the last 5 years, we're looking at about 33%, and free cash flow yield of just close to 4%, which is really nice to see. Profit margin, return and operating margins, and return on equity, return on invested capital is decent for a company that's growing, especially the return on invested capital, which is really good. Okay. And the next part is the net income. So net income, as you can see, we got 21%. Total return in the last 5 years, okay, for this year is about 20% per annum, which is really good. The revenue compound annual growth rate for the last 5 years is about 28%. EPS is about 30%. And current ratio, we've already seen the company has more current assets, okay, than current liabilities, so that's covered completely. Now looking at forward, revenue growth for the next year is about 16%. EPS growth for the next year is 23%. Now if we go back to here and click earnings, and you will see, okay, the year that I'm looking at is this, but this year they were expecting about $116, basically 116% up, basically year over year. Okay, then the following year is basically 22, which we've seen already. The 2026 is about 40 something, so high double digits every single year when it comes to EPS and revenue. Okay, and this is probably why a lot of people are talking about this company right now. According to Morningstar, they're saying that currently it's basically it is fairly valued. It seems undervalued, to be honest, because $65 per share, and they're saying it's about 80. The fair value is about $80 per share. These guys are crazy ridiculous. Okay, $152 per share is where they think the price should be. That's over 50%, than basically higher than where it is right now. Tip rank is actually saying $93 per share. That's about 38% upside from where we are. They're saying it's a strong buy. Seeking Alpha 90%, 32% upside from where we are right now, and then it is a buy. So I'll show you basically my own valuations for this. So just stay tuned for that. Uber. Now, in terms of our compliance side of things, nothing to worry about. Interest-bearing debt, interest-bearing securities is very low, and business activities is about 99 something. Okay, and as you can see here, they have not been buying that. Basically, they diluted the shares, and that's what you expect from a growing company. So in 2020, they had 1.7 billion basically shares out there, 1.9 in 2021, 2022 was 2 billion, 2023 we're looking at 2.07. Okay, so it was basically slight increase, and I'm sure they will continue doing that until the company, because they use that basically money to actually reinvest in the business and grow the business and so on. All of these autonomous driving and all of these things, someone has to finance. So rather than going to the bank and getting a loan, this is what they do, which is fine. I'm cool with that, as long as the company is not just doing it. A profitable business should not be doing that consistently. Okay, so that's the overall. So what I'm going to show you now, guys, is to basically show you the valuation side of things. Okay, and as you can see here, we've got Uber, we'll get the company, Morningstar valuations, Simply Wall Street valuation, Seeking Alpha, and then I used the discounted cash flow model, which gave me about 71. Now I'll be honest with you, because the company has a basically negative free cash flow, whatever it's the last few years, when you take all of this into consideration, it gives us at least a 98 basically percent. This is the issue. If I take this out, we will be about 80, which is realistic. Okay, which is what Morningstar is saying. These guys, like I said at the beginning, is ridiculously crazy. However, even if we use that, okay, current stock is $65 per share. That's 52% upside from where we are. So if we take this out of the equation, and I will do that right now, okay, so that gives us about 23% upside from where we are. If you include 15 basically percent or 20% if the company is too volatile, then you can buy this stock right now for $65 per share, and up until it hits that, up basically, I don't know, maybe another 10% or so. So overall, it seems undervalued. It seems fairly valued kind of stock right now. But what you really need to take into consideration is this thing here. Okay, the fact that the growth is there, but would it be there? And also the fact that there's a lot more competition out there. So if you're looking for a a high growth company for the next whatever years, then potentially you can take that bit of a risk. But like, again, it is a risk. What would I be doing? I'm interested. However, I don't think I will be buying it now. I want to see where the market is by the time we get to the beginning of the year. So 2020, beginning of 2025, if the stock is still around here or below this, then potentially I might add it to the family portfolio. But that will be about 2% of that portfolio, no more than that, because I don't like these high growth companies. Anything can happen, and I don't like the fact that the stock doesn't have a wide mode, and I know there is a lot of competition out there. And if I'm going to keep an eye on a few things, I'm going to keep an eye on the free cash flow, I'm going to keep an eye on the basically the balance sheet to see how this is going, okay, and if the companies are innovating and so on. So there's a lot more research I need to do. This is just a kind of overview, if you like. If you enjoy this type of content, please join us at the Patreon account. It takes a lot of time and effort to put these things together. I would appreciate if you could join us. Have a wonderful day. Assalamu Alaikum.